So China, we talk about China all the time. They're the second largest economy in the world. And what we're seeing in China really over the past, let's call it 6 months or first 6 months of this year, maybe towards the end of even last year, is an economy that has struggled to gain its former glory. Once upon a time, China had double-digit growth, over 10% growth. Started to fade a little bit over the past few years, heading into COVID and what we saw during the pandemic, but they were always 7, 8, 9% growth. Well, coming out of the pandemic and coming out of some of those lockdowns that they had, their zero COVID policy, et cetera, China has struggled, and they've struggled to regain the growth numbers that they had prior. And what that country has done recently, and we have a chart on that here, is the People Bank of China, they've cut their rates. And you can see the one-year loan prime rate has fallen. And it's interesting, if you were to, not that we have this, but if you were to put this chart on top of the Bank of Canada chart, or even better, the Federal Reserve chart, these two charts would be going in opposite direction. China is cutting rates to try and stimulate growth, whereas the United States and Canada, we're actually raising rates to slow down growth, which is interesting. But what's happened out of China has actually helped us quite a bit. By China slowing down, it has helped because we aren't seeing the high inflationary data that we may have seen if China was going like gangbusters right now. We would probably see them importing a lot more energy, importing a lot more oil. We would probably see oil prices significantly higher, and that would cause a lot of inflation. We possibly could see supply chain issues still happening if China was their growth rates were extremely high, tough to get things out of China, et cetera. Now China is trying to export as much as they can. They're trying to alleviate supply chain gluts because they're trying to have better growth numbers. So their numbers are better, so their people can have more jobs, et cetera. So what's been happening out of China has definitely helped the West in some respects keep inflation down. And even though interest rates have gone up tremendously over the past year and a half, imagine what would happen if China was growing a lot hotter or a lot more. We probably would be seeing inflation falling at a lesser rate or less fast than we're seeing it now. So a slowdown in China has helped in a lot of respects the fight against inflation. I think overall the businesses around the world are hoping that China starts to pick up the pace a little, especially businesses that do business directly with or in China. Starbucks comes to mind, Tesla comes to mind, Caterpillar, Apple, a lot of the semiconductors, the chip makers, whether it's an NVIDIA, a Micron. These are companies that hope that China starts to pick up in terms of their growth. I have a chart here on the Shanghai, which is the index in China. You can see how, I guess, poorly that index has fared over the last, I guess it's a one-year number. We can see that China obviously hasn't fared as well as North American indices. So overall, slowdown in China has helped the inflation or the fight against inflation, but I think we're going to start to see the pace start to rise coming out of China. I think they're going to start to do a little bit better. And again, if you own stock or own shares of companies that do business in China, this will definitely help their share price.